Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing TAL stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a mid-cap company, 5.4 billion market cap. They're trading at $9 a share, and they have 600 million shares outstanding. This company provides K through 12 after-school tutoring services in China. China is a huge market for tutoring and additional education. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their numbers improved a lot. Look how bad it was in 2021, negative 1.2 billion. And their revenue was really high. Looks kind of odd, right? A small negative in 2022, positive in 23, growing a lot, up 66% in 2024. Good margins, they converted 19% of their revenue to free cash flow. Net income, a similar trend, big negative in 21, small positive in 24. Revenue is a sales for the company, and that went down 77% from 21 to 22, but then grew a lot in 23, almost 50%, up 9% in 2024 to 1.6 billion. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's 5.7 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $5 billion. We divide that by 599 million shares. And we get a calculated stock price of $8.41. They're trading at $9, so they're trading at a 7% premium. It's a sell according to the model. What do you think? Do you think it's a buy or a sell? Let me know in the comments. Once again, Simply Wall Street is really bullish. $21 a share. They say they're 58% undervalued. There are 42 companies in the same industry as TAL. If they have a number in red, they're worse than median. If they have a number in blue, they're better. They spend 117 million in capex, a lot higher than the median average. Really good debt to equity ratio. For every dollar of equity, only 10 cents of debt. They generate 300 million of free cash flow, second on this list. They're the second largest company on this list at 5.4 billion, a little less than half of EDU. Really weak price multiples relative to the median, although their price to book and price to free cash flow are better than the average. They generate 1.6 billion of revenue, which is a lot less than number one EDU, also less as a percent of their market cap. Their price to sales is worse. Look at their 5-year annual revenue growth rate, a big negative 10%, the only company that's negative on this list. I wonder if they spun off or divested one of their business units, because they had a big drop in 2021 to 2022. The drop is so significant, so it looks like they broke apart the company. Here's their latest income statement. All their numbers are in US dollars. Revenue up a lot. It was 275 million in the 3 months ending 5/31/2023, up to 414 million. Cost of revenue, all the expenses directly tied to generating revenue, 200 million. Gross profit, 214 million, up a lot. It was 136 million last year. Marketing, they spend 122 million. G&A, 110 million. Expenses up very little. It's 230 million. They do get a lot of government subsidies. Last year they did almost 9 million. This year, not as much. Their loss from operations improved a ton. It was a loss of 58 million. Now it's 17 million. They received 23 million of interest income. That's interest on their cash, on their investments. They received 13 million of other income. So they actually have a gain before taxes, a gain of 15 million. Last year they had a loss of 42 million. So they have positive net income, positive 11 million. Last year they had negative net income, negative 45 million. Big improvement. So to summarize, I have them trading at a 7% premium. I give them a ranking of 4 out of 10. Would I buy them 2 out of 10? Doesn't look so great, and I don't like investing in Chinese stocks. Ratio is 3 out of 10. They're a bit weak, worse than the median in every category. Financials, 4 out of 10, because even though their revenue has come down a lot since 2021, it is up a good amount since 2022, up 60%, and they have positive free cash flow the last 2 years. A company that dropped revenue from 4.4 billion to 1.6 billion deserves a 1 out of 10, but they're doing a good job at generating positive cash flow. So that's the end of the video. Let me know what you think. Give it a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.